All right, in this lesson, we are going to go over a simple example for FIFO, just so that you can understand the mechanics of FIFO. And then in the next lesson, we'll give you more of a comprehensive problem, including quantity issues that you might incur in the real world. So let's start off with the example prompt here. Company A is a wholesaler who buys machines from a local manufacturer and sells them directly to a customer or to customers. Company A has purchased 5 machines to sell for their customers, and the information is shown below. So we've got information on the 5 units that they have that they can sell to customers. In the month of May, Company A sold 2 machines. They sold B and D that were sold to their customers. What is the cost of goods sold for May, the ending inventory, and the gross profit for the sale of these 2 machines, assuming the FIFO method? And then it's going to ask us what is the journal entry, which we'll get to at the end of this lesson. So here is an example of, we've given the details and we know the details, so we could literally use specific ID, but it is the company's policy that we use FIFO. So even though we're given the details, even though we can use specific ID, we are not allowed to use it because company policy says we always use FIFO for inventory valuation and costing method. So that being said, we are going to use a FIFO. Now, if you remember, FIFO means first in, first out. So the cost of the very first item in will be the cost that leaves first, no matter which item the customer chooses. So in this case, the customers have chosen B and D. But we are not going to move those costs necessarily unless they are the first 2 costs that came into our business. Now, if you notice right here, we've organized the machines by purchase date so that we have the earliest to the latest as far as when they came in. So machine A obviously came in first, B second, C third, D fourth, E fifth. So the way that we apply FIFO is we actually take the first cost and assign it to the first product that was sold. So in this case, our first cost came on January 12th, 20x1 in the amount of $12,600. So we're going to transfer $12,600 from inventory to cost of goods sold, and that's going to go for machine B. And yes, machine B cost $12,800, but we're going to move the first cost and the first cost only. Then we're going to need another one. So we're going to work our way down to the next cost. The next cost happens to be B, but we're going to assign that to D, assuming that we sold D second. So we're going to pull $12,800. Now notice that machine D, we bought it for $14,350, but we're only moving $12,800 because we are using the FIFO costing method. First in, first out. So we've got our 2 amounts here, $12,600 and $12,800 that we are going to move. So to give us a little bit of room here, we're going to move things around here. So right now our inventory is sitting at $68,950. The first thing that we need to do is assign cost that's going to go from inventory to cost of goods sold. We said that we've sold 2 units, so we're going to start from the top, $12,600 and $12,800. So what we're going to move $12,600 plus $12,800 gives us $25,400. So that's what we're going to move. We're going to move $25,400. So I can put $25,400 in inventory, $25,400 in cost of goods sold. And so I'm literally moving $25,400 from inventory to cost of goods sold based on the FIFO method. Notice that D's cost is still there, but we've already sold D. So the $14,350 is still there, even though we've sold it. Okay, now let's calculate ending inventory. So the way that we calculate ending inventory is we can use the T accounts, or we can literally take the beginning balance, which is $68,950, and subtract it by how much we've already transferred out of inventory. In this case, $25,400. If I do that subtraction, I get $43,550. So $43,550 550. So what's left in inventory is 43,550. If I were to add up the three costs that are still left, which would be C, D, and E, that should equal $43,550. Probably should check my work, but that's what it should be. All right, so we also need to calculate gross profit. How do we calculate gross profit? It's revenues minus cost of goods sold equals gross profit. So my revenues would be the cost of the sales price. In this case, the sales price is the same, and it's the same on purpose. So it's $18,000, and it doesn't matter which one we pick. It could have been from B or D or A, but we sell them all at the same price. So 18,000. So if I sold 18,000 for one machine and 18,000 for the second machine, that means I had total revenues of $36,000. If I subtract my cost of goods sold, my cost of goods sold is 25,400 minus 25,400. I get a profit or gross profit of $10,600. So that would be my gross profit for this example. All right, so that's how we calculate the mechanics. Now let's look at the journal entries. Remember that our sales was 36,000 and our cost of goods sold is 25,400 because we're going to need those two numbers to do the journal entry. So 25,004 and 36,000. All right, let's do the journal entries. Remember that when we make a sale, we have two sets of entries that we need to make: the sale of the goods as well as the cost of the goods. So the sale of the goods is the first thing. Now it doesn't tell us how they paid, but we're just going to assume cash because it's the easiest. So we're going to debit cash in the amount of 36,000 because that's how much they sold it for. And then we're going to credit what brought in the cash, the sales revenue brought in the cash. Credit sales revenue of 36,000. Now we're crediting sales revenue because sales revenue is a revenue account. Increases in sales revenues are credits. We're increasing sales revenues because we've incurred sales revenues, so that's why we're increasing that. Cash is an asset. The asset increases. When an asset increases, we debit the account. So that's kind of how we got the debit cash, credit sales revenue if you don't remember the journal entry process. All right, the cost of the inventory is next. We know that the cost of the inventory was $25,400 based on our calculations under FIFO. So we need to debit our cost of goods sold because that's what it costs us and that's where it needs to go. And we're taking it out of inventory. So we're going to credit inventory for $25,400. So we're going to pull it out of inventory and put it into cost of goods sold because we've sold that inventory and that inventory is no longer in our possession. So we don't want to put that in our inventory account or leave it in our inventory account if we don't have it in our possession. So that's the journal entry for the sale of the goods. So that is a look at a first in, first out, simple mechanics. Really what I wanted you to get out of this lesson is understand that we line up all of our costs by date, and then we start picking from the top. Okay, pick from the earliest one, then the second earliest one, and we keep going down until we've already allocated to all of the units that we've sold in the period. In this case, it was just 2, so we picked off the first 2, no matter which item the customer takes. In the next lesson, we are going to look at a broader example, a little bit more involved, kind of the same steps that we just did here. We're going to lay it out a little bit more. We're just going to lay it out a little bit more. There's going to be more to it because we have quantities to deal with. So we will work on that in the next lesson. So I hope you enjoyed this video and we'll see you in the next lesson. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.